You're welcome again to yet another class on corporate reporting. And I hope you had a wonderful day. So I welcome you again to Equity Professionals. Today, we are going to be moving forward. So far, on corporate reporting, we have done two topics on my part. We have looked at regulatory framework. We have also looked at conceptual framework. Now, today, we will start looking at the core accounting standards at your level in corporate reporting. And the very first is going to be IFRS 2 on share-based payments. So what is this standard? What is it talking about? What it's talking about is that most entities, when they carry out transactions with suppliers, with employees, when they buy goods, or when they receive services, they are now paying through their shares by issuing their shares or share options. So they are using their shares and share options as a form of consideration. And the most popular one is the one that they use for executive remuneration or directors' compensation. You will find out that most entities would promise their directors or their executives certain amount of shares in the future if they are able to achieve certain profit target. They will promise them that they will give them a lot of shares of the company. And even in some countries, they have even started offering tax incentives to companies that gives shares to their employees. They would make that kind of shares or the ultimate staff cost to be a liable expense when they come for or when they are filing their tax returns. So therefore, entities have found a way of using their shares to make payments. So instead of them using cash or to pay outright cash or to even defer payments, they are now using their shares as a form of consideration. And that's the major discourse for tonight. And that is what IFRS 2 is talking about. That how do you account for a transaction where entities use their own shares or their own share option as consideration or as a form of payment for the goods or for the services they have received? IFRS 2 would actually take care of that for us, and that is the whole idea behind share-based payments. So that's the introduction to this standard. Now, there are majorly three types of share-based payments. There are three types of it. Number one is equity-settled share-based payment transactions. And for equity-settled, as the name implied, this is one in which the entity receives goods or services in exchange for equity instruments of the entity. Just like I've explained before, they receive goods, an entity receives goods or services. they bought goods or services. So instead of them paying cash or the normal way of payment, they decide that, okay, we are going to issue our shares for consideration. We are going to issue our shares for consideration. And it could be option also. So that is equity settled share-based payment. The second one is cash settled share-based payment transactions. For this one, entity receives goods or services in exchange for an amount of cash that are based on the price or value of the entity's shares or other equity instrument. So for cash settled, the entity receives goods or services, meaning they bought goods or services, and the way they will pay is through cash. But that amount of cash will now be based on the price of the entity's shares or other equity instruments of the entity. So ultimately, they are still tying down, or the amount of money they will pay is still based on the share price of that entity. So the entity receives goods and it says, look, I will pay for these goods. However, if you believe in my company, my share price is 5 naira. Whatever the value of my share price is in the next 1 week, I will pay you based on that. Based on that. And probably they will have agreed the number of shares. So this is this, right? As it will be very attractive if the company that is offering you this form of payment is a performing company or a popular company that everybody knows that they are doing very well. Like multinationals like Apple, for example, or Google, or even in Nigeria, let's say GT Bank, or some banks that are doing very well. Let's say Dangote, yeah, they are also doing very well on the market. So if they offer such form of compensation or payment, a lot of people would, or a lot of suppliers will key into it because they know that it will mostly be favorable. It will pay. It will be good. So cash settled share-based payment. An entity receives goods in exchange for an amount of cash that are based on the price of the entity's shares. Cash settled. And the third one is transactions in which the entity receives goods or acquires services, and either the entity or the supplier has a choice as to whether the entity settles the transaction in cash or issue equity. So this third one is where there is a choice of settlement. Where there is a choice of settlement. And either the entity or the supplier will ultimately decide that, okay, for these goods you have received, how do you want to pay? Do you want to pay in cash? Of course, when I say in cash, the amount of that cash will be based on the price of the entity's shares. Or do you want to pay by issuing shares or share option? That's the third one, where there is a choice of settlement. So everything I'll be talking about today is around these three. Everything I'll be talking about. I am sure that I will finish this first one today. you would understand how to recognize and measure this today. Then next week, I'll talk about this second and third one. So my focus for today is equity settled share-based payment. So those are the three types of share-based payments. Now, before we go to the core accounting, how do we account for this type of transactions where entities pay through their shares or share option? How do we account for it? So there are certain terminologies we are going to meet that you need to be conversant with. And the first one is share-based payment transaction, which is a transaction in which an entity receives goods or services as consideration for equity instruments of the entity, or acquires goods or services by incurring liabilities to the supplier of those goods or services for amounts that are based on the price of the entity's shares or other equity instruments of the entity. So that's a share-based payment transaction. Just like I've explained, they receive good, and that will be, and they will pay for that goods with their equity instrument. That's their shares or share option. Or they will receive good by incurring a liability to the supplier. This is the second one of cash settled, where they would pay cash, but the price or the amount of cash will be dependent on the price of the entity's shares. So that's a liability because they are not paying the cash now, they will pay it later. So they incur liability for those goods or services, but the value of the liability are based on the price of the entity's shares. Then, before you can enter into a share-based payment transaction, there must be an agreement. And that's a share-based payment arrangement, which is an agreement between the entity and another party to enter into a share-based payment transaction, which thereby entitles the other party to receive cash or other assets of the entity for amounts that are based on the price of the entity's shares or equity instruments of the entity, or to receive equity of the entity, provided the specified vesting condition are met. Okay, so for every share-based payment transaction, there has to be an agreement. So an agreement is, there must be a share-based payment arrangement. Now, I've been mentioning equity instruments, and from your knowledge of conceptual framework, you know that an equity instrument is a contract that evidences residual interest in the asset of an entity after deducting all its liabilities. And when we talk about equity, we're talking about share capital and reserves, majorly. Then equity instruments granted. So when an entity grants or issue equity instruments, what the entity has done is that another entity now has the right, is the right to an equity instrument of the entity conferred by the entity on another party under a share-based payment arrangement. Then, whenever I mention that the entity is paying through their equity, I will say shares or share option. There is a huge difference between shares or share option. So when I just say shares, that means outrightly they will give the guy shares immediately. But share option is a promise to give shares. Is a promise to give shares. So, and that promise is provided you meet certain conditions. So a share option is a contract that gives the holder of that option the right, but not an obligation, to subscribe to the entity's shares at a fixed or determinable price for a specified period of time. That's a share option. So when an entity issues a share option, what it's saying is that I will give you my shares if you meet certain conditions. I will give you my shares if you meet certain conditions. And those shares, I will give you at a specific price at a specific future date. That's a share option. So today, we would focus a lot on share option because that's the one you'll find in the exam. That's the form of payment you would find in the exam if the examiner wants to test it. They will not test shares because that one is kind of straightforward. But it's the one that would happen later in the future that they will test because they want to test accrual basis of accounting and see whether you would treat it rightly or wrongly. Let's continue. Then the next one is intrinsic value. So intrinsic value is the difference between the fair value of the shares to which the counterparty has right to subscribe or which it has right to receive. So the price, the difference between fair value of the shares, that is the market price of shares, right? And the price the other party is required to pay. They call that exercise price. Okay, so if I issue my shares or share option to any of you in this class, me that I'm issuing shares, I have to be like a listed entity. A company that wants to enter into this type of transaction would mostly be a listed entity, not necessarily though, but of course they must have outstanding shares. So when they issue it, of course, there will be an existing market price. There will be a subsisting market price. However, in order to encourage you or compensate you, depending on the arrangement, so you guys could agree a price different from the entity's market price, different from that. So whenever you now want to pay for those shares I'm issuing you, that's the price you will pay, the price that me and you will have agreed. They call that exercise price. So for you guys now that you are buying the shares, the ultimate value of that transaction to you or the ultimate benefit of that transaction to you is this intrinsic value. Is this because why would you want to, sit on shares, collect shares, rather than when you can easily demand for your money? Just give me my money. So the benefit you are looking at on getting is what we call intrinsic value. This is part of the benefit involved that would attract you to want to have it. So, and this usually occur where the issuer or the entity that wants to issue the shares to you has discounted the price for you or has reduced the price for you and only you, right? So, for example, when you have a share option with an exercise price, don't forget, exercise price is the price you will pay, that you actually pay for those shares. It's 15 naira. But the market price or the fair value of those shares, if you are supposed to buy it in an open market, it's going to be 20 naira. So the intrinsic value is 5 naira. That's like the inherent benefit for you. Then the grant dates. This is the date in which the entity and another party, including an employee, agree to a share-based payment arrangement. Okay, so the date we sign the agreement, the date I promise that, okay, oh, I will give you some of my shares as a form of payment for the services you had rendered to me. That date is the grant date, the date we have agreed. We have agreed. So entities usually enter into these transactions with different set of people. Of course, usually suppliers, consultants, even their employees. So for employees, the grant date is going to be the date they agree with the employee that, okay, I'm promising you, there will be a contract. So the date on that contract or the approval date, I'm promising you that, okay, if you work for me for 5 years, I will give you shares. So the date they made that promise, the date they agree is the grant date for employees. You see, that date is quite different for suppliers, the external people. Grant date is going to be the date when you receive the goods or services. That will be the grant date for suppliers and consultants. That will be the grant date. Finally is measurement dates. So measurement date is very similar to grant date. So measurement date is the date at which the fair value of the equity instrument is measured. So for transactions with employees, the measurement date is the same thing as the grant date. Is the date you agree with the employee that, okay, I will give you shares so if you meet certain conditions, like the date you agree. But for other people, the measurement date will be the date when you receive the goods or services. So measurement date and grant dates are extremely similar. That's the first part of what we have to do today, which is what will form the foundation to our discourse for tonight. To be sure that you're with me, let's test ourselves with these few questions, which is just trying to see if you heard everything I've said so far. Quiz 1. Which of the following is not a type of share-based payment transaction? A, transaction where entity receives goods and either the entity or the supplier has a choice as to whether the entity settles in cash or equity. B, transaction where an entity receives goods and settle the transaction with equity. C, transaction where an entity receives goods and we settle in cash in 2 weeks. Transaction when an entity receives goods and settle in cash that are based on the share price of the entity. What's the answer to this? That's correct.
C.
C. That's correct. Yes. C is the answer. Because this is not among what we have mentioned. Transaction in which the entity settle in cash in 2 weeks. This is a normal transaction because it has nothing to do with shares. So this is out of it. Question 2. The transactions where an entity receives goods or services in exchange for the equity instrument of the entity is known as cash settled, equity settled, share-based payment transactions, none of the above.
B.
Equity settled. That's correct. Number 3, transactions where an entity receives goods in exchange for cash that are based on the share price of the entity is known as equity
Cash
settled.
settled.
Correct. Number 4, a contract. Okay, for the fact that you guys got 1 to 3, that means you understood everything I've said so far. So now I want to ask further questions. So be very careful here. Look at this one very closely. So a contract that gives the holder the rights but not the obligation to subscribe to the entity's shares at a fixed or determinable price for a specified period of time is known as equity
Share
option.
option.
That's correct. Share option. Share option. Correct. So if you go for option, you'll be wrong because that one is also a right, okay? But is a right to subscribe for any other thing. It could be shares, it could be assets, it could be a lot of other things. But this one is very specific to rights, not an obligation to subscribe to an entity's shares. So it's share option here. Correct. So number 5, the transaction in which the entity receives goods or services as considerations for equity instrument of the entity or acquires goods or services by incurring liabilities to the supplier of those goods or services for amounts that are based on the price of the entity's shares or other equity instruments. Equity settled, cash settled, share-based payment transaction, equity instrument granted.
Sorry, can you scroll down? I can't see the other options. The share-based payment transactions.
That's correct. Share-based payment transactions, because it encompasses both equity and cash settled, so it's everything we're looking at. Fantastic. Next, an entity issued a share option to its employees. The entity's share price is 18 naira. The employee has the right to buy these shares at 12 naira when all vesting conditions have been met. The price of the share option is 7 naira. What is the intrinsic value? What is the intrinsic value? So Jide said B, and that's correct. The answer is 6 naira. The share price minus the exercise price. That's the intrinsic value. So somebody already got it, 6 naira. Then finally, uh, an entity issued share option to its employee on 30th June 2023. The end of the year is 31st December 2023. The employee will be entitled to the shares on 30th September 2024. What is the grant date?
A.
Correct. Correct. You guys are very smart. Okay. Good. Now, I think we have started on a very good footing. So let's see if you understand the next one. So now let's go to the core accounting itself. So first, when I say core accounting, then I'm talking about recognition and measurement, right? I already mentioned that in conceptual framework. Recognition is a fancy way of saying recording. That's recognition. So how do you record share-based payments? Be it equity settled, be it cash settled, be it the one where either of them can decide whether cash or equity, right? So IFRS 2 said that an entity would only recognize the goods received or acquired in a share-based payment transaction when it obtains the goods or services. Okay, this is extremely important. It might look like a one sentence or like a one-liner, but I need you to digest it. That the transaction is not recorded when we agree. It is not when we agree. It is not at the agreement date. The transaction is recorded when the entity has started enjoying the goods, when he has obtained the good, when he has received the services. I need you to digest that and never forget, as far as share-based payment transaction is concerned, that is when you can record it or recognize it in the books. That's one. Number 2, You see, those goods or services you receive, okay, you would usually will recognize them either as expense or assets, depending on what you have received. Mostly, if it were to be services, right, you would expense it because services are usually rendered immediately. Whether somebody offered legal service or accounting service, I mean, they just offer the service and move on. So you would usually expense those services. And it could be it could be an asset, something tangible or goods. So if it's an asset, then you recognize it as an asset, or if it's purchases that you purchase goods, then you recognize it as an expense. Okay. So that's how mostly the goods you received or services you received are recognized, either as assets or as expense. Just put it as asset, depending on what you have received anyway, right? Now, if that goods that you receive now, if the agreement is equity settled, if it was like a situation whereby you'd opted to pay for those goods with your shares or share option, okay, then in addition to recognizing those goods as either expense or assets, you must also recognize the second leg in equity under reserve. They call it equity reserve. You know, when you are recognizing, it's usually two legs. So whenever you enter into an equity settled share-based payment, you recognize one leg as expense or assets, depending on what you are receiving. If it's mostly services, it is going to be expense. If it is assets, it will be assets. And depending on the materiality of the item, anyway, that's one leg. The other leg is in equity. And it makes sense because you're actually giving out your shares. So it makes sense to credit your shares because your equity will increase. So that's for equity settled. But if the goods you received, if it is in a cash settled share-based payment transaction, okay? So in addition to recognizing expense or asset for the goods you receive, the second leg you credit is a liability now. Is a liability. And it is a liability because you have an obligation to deliver cash. You are owing. There's an obligation to transfer economic resources. That is a liability. In this first one, you don't have an obligation, but you need to issue out shares. So we credit equity. In this cash settled, don't forget, for cash settled, you are going to pay with cash, though the value or the amount is based on the share price of the entity, but you are still ultimately paying with cash. So when you have an obligation to deliver cash, don't think it twice. That is a liability. That is how you recognize share-based payment transaction. I'm intentionally leaving the ones where there is a short choice of settlements because I don't want to go there now. There's a little bit of complexity there because of there will be like a component of both equity and liability in that one. So I would treat it specially. But for equity and cash settled, while the other one for equity will be credited to equity reserves under equity, the other one goes to liability. Okay, so I've explained it. So let me be sure that you had me. Quiz. Number one, an entity purchased the motor vehicle under an equity settled share-based payment transaction, how will this transaction be recognized?
D.
D. That's correct. Number 2, an entity received a legal service in exchange for its shares. How will this transaction be recognized?
A.
A. A.
That's correct. That's correct. Number 3, an entity purchased goods under a cash settled transaction. How will this transaction be recognized?
A.
C.
Sorry. Increasing liability. So
C.
C. Yeah.
That's correct.
May you help me scroll down? I don't think I saw the last one. Yeah.
That's correct. Yeah. I went to put the wrong answer. The answer is C. It's a cash settled. Okay, good. Now, the final part, measurement. So for measurement now, we are going to pick it separately. I would look at measurement of equity settled. I should finish that one today, every part of equity settled. Then next week, I will look at measurement of cash settled and where there is a choice of payment. And also, thankfully, you have done deferred tax. So I'll be able to teach you the deferred tax implication of all of these transactions, because you would see that there is an apparent deferred tax implication here. So let's pick it step by step. Now, measurements, okay? So you see, when it comes to the measurements, there is a very clear challenge here. There's a very clear challenge. So the issue we have is how do we measure the cost of the goods we are receiving and the equity we are granting? And why is it an issue? The issue is that whatever goods or services we are receiving, of course, the supplier knows how much he wants to sell it. So that one has a distinct value. The shares I want to issue, there is a price everywhere, especially for listed entities. That one too has a distinct value because there's a share price that's already in existence. So the challenge is, okay, which one are we using? Are we using, for this transaction, are we using the value of the goods or the value of the shares? Because it's the amount you debit, you must credit in accounting. Okay, so they have to be the same, otherwise your account will not balance. So the principle in IFRS 2 is that you would recognize it will be recognized based on the fair value of the goods or services. So we usually would follow the fair value of the goods or services. That's what will prevail. So both the entities, both the debits, the expense or the assets, and also the corresponding increase in equity, all of it will be measured at fair value of the goods or services. Let me juggle our mind a bit, okay? I just want you to participate a little bit now. Why do you think that they are going for fair value of the goods or services? Why not fair value of the shares or share option? Is there anybody that can think of why this standard is going for the fair value of the goods or services? Anybody? You see, the reason is that somebody that is selling he already has a selling price. He will have sent you an invoice. So, and that is the basis at which we should measure the goods. So, and that's what you are paying for. So, for the fact that you chose to pay with your shares, so that one is up to you now. But ultimately, this transaction, the driver, the underlying transaction is the goods or services. The underlying transaction here is not the shares. Yes, you are paying with your shares, quite all right. But the key point is the goods you bought. So that's why primarily we should measure the transaction at the fair value of the goods or services. And it's quite easy when the transaction is with a supplier. It's very easy to determine the fair value of the goods or services. It's very easy. And this fair value of the goods or services, you would get the fair value or recognize it at the dates where you receive goods or services. Okay, that has already been mentioned. Now, it's important to note that there are situations where you cannot measure the fair value of the goods or services reliably. Then, in such situation, you will then value the transaction by reference to the fair value of the equity instrument granted. Then you measure it by reference to the fair value of the equity instruments granted. And in what situation would you be unable to determine the fair value of the goods? The only situation mentioned in IFRS 2 is where the supplier is your employee, which is going to be the focus of the rest of what we are going to be talking about, is where the transaction is with an employee. It is very difficult to determine that, okay, for this portion of what this employee has worked, this is the value of the goods or services, because ordinarily you would ordinarily pay your employee salary. So share-based payment would just be a component of the remuneration package of that employee. It's just a component. So when you now want to measure or recognize that portion of the remuneration package, then you cannot measure it based on the fair value of the services or goods you received from that employee. You have to use the fair value of the equity instrument you are granting, because there's no reliable way of saying that, okay, for this part of the service this employee is offering, this is the value. And so that's that for measurement. And you see, why this standard is so important right now is because when startups started coming up, we saw that a lot of them were giving their employees shares, right? Just that it's not shares they give them share option, which is that, okay, you have rights to get my shares, but in the future, when you meet certain condition at a future date, at a future price. So what happened then was that since it was something relating to the future, these transactions were not being recorded in the books at all. So, like an employer promised that, okay, if you work for me for 4 years, then I will give you 500 shares. That's the situation here. So it will not be recorded in the books until the expiration of that 4 years. That is when it will now be entered in the books. So that was wrong. That was wrong. It should not be treated that way. And that's majorly is going to be the focus of this class. Okay. And why is it the focus? You see, the one with supplier is quite straightforward. It's very, very straight. There is nothing special there. So I bought goods from a supplier, then I agreed to pay the guy with my shares. This standard is clear. He said that you should measure it based on the fair value of the goods or services received. So just debit P&L, then credit equity. That is all. That is it. So the examiner will not ask you that one. Even if they ask you, just that is it. It's not more than that for suppliers. But for employees, right? Because employees would be with you for a long time, and before they will get that shares, you would have given them certain condition. So there are ways. So that's where we want to correct. That's where entities are making mistake. They don't put it in the books. They will say, ah, Shebi, we have not given him. We have just agreed. So they will now wait until that when the employee meets that condition, they will now recognize it in the books. That's wrong. Okay. So now we'll get there. So based on what I've explained so far, look at this. Picture this. A company issued share options on 1st June 2006 to pay for the purchase of inventory. The inventory eventually was sold on 31st December 2008. The value of the inventory on 1st June was 6 million, and this value was unchanged up to the date of sale. The sales proceeds was 8 million. The share issued have a market value of 6.3 million. How will this transaction be dealt with in the financial statement? So this is similar to what I was explaining to you, right? So I bought goods and I decided to pay with my shares. I know that they told me that the value of the good is 6 million. The net realizable value of the goods is 8 million. The value of the shares that I want to issue is 6.3. So which value are you using to debit and the credit? Is it the 6.3, the 8, or the 6? It's the 6, because that's the fair value of the goods or services. That's the value of the goods or services. So you use this 6 million to debit either your inventory, then you credit your equity reserve with the same 6 million. Now, fair value is a term that we're going to use a lot, and is the amount an asset could be exchanged or liability settled or an equity instrument granted could be exchanged between knowledgeable willing parties in an arm's length transaction. So this definition is only for IFRS 2. I will teach you another definition in IFRS 13 for fair value, right? So that's fair value. How do you determine fair value? Okay. I mean, it's the market price. If you have to get fair value for shares, it's the market price. So if market price is not available, so we use certain valuation technique, which is beyond the scope of this exam. So we'll talk about it. That's fair value. Then vests. There's something we call vests that I will be mentioning going forward. So vest is to become an entitlement, or like I've said, when the employee has worked for that period, he has met those conditions. Okay, after like maybe 3 or 4 years, I've told him he has to work for 4 years and he has worked for 4 years. Then after that 4 years, that share option will vest, meaning the employee is now entitled to it. So it has vested or it has crystallized. Okay. So under a share-based payment arrangement is the counterparty's right to receive cash assets or the equity upon satisfaction of the vesting condition. And you see, this vesting condition is the condition the counterparty must satisfy to receive those cash, other assets, or equity under a share-based payment arrangement. And this vesting condition usually would be service condition, that you must work for 4 years, you must work for 5 years. That's the popular one you find in the exam. But it could also be performance condition, where the employee will have a profit target. The employee would have a profit target or a sales target. Then that will be performance condition. And the period over which you're expected to meet that condition is vesting period. That's vesting period. Okay, that being said, so still on measurement of equity settled, you have already learned that you measure it at the fair value of the good received. But if the transaction is with your employee, then it will be measured at the fair value of the shares or share option. However, when an entity receives when they receive services, those services could either be received or satisfied immediately or over time. You see, where the services is received immediately and that one is not difficult, because the equity instrument will vest immediately too. So, for example, now an entity issued shares of 2,000 in exchange for legal service, and the lawyer sent in 2,500 naira. So these transactions will be recognized immediately at 2.5 when the legal service is received. So as soon as the lawyer offers his service, you recognize 2.5 as expense, you recognize 2.5 as equity reserve. But where the service, so again, ICANN will not ask you this simple one, because it's not more than that. But where the entity receives services over time, okay, usually where the counterparty will be required to meet a condition first. For example, an employee may have to complete a specified period of service. So this is usually common with employee, where they have to work for 4 years or 5 years. So that means the transaction will now cover more than 1 year. So for example, now an entity issued share options to 3 employees on the condition that they work for 2 years. So the value of the share option is 10,000 naira. And don't forget, when you would enter into a share-based payment or equity settled share-based payment transactions with your employee, you are going to measure that transaction at the fair value of the share option or the shares. So now we're going to measure at 10,000. But because the service is over 2 years, don't wait until when the employee has offered the service or when he has completed all the service before you recognize it. Since this service is over more than 1 year, so at the end of the first year, recognize the portion he has done. At the end of the second year, recognize the portion he has done. And that is what we will spend the remaining time learning how to do, how to spread those amounts into many years the employee has worked. So I will need you to open your eyes and participate fully. So for this one now, since they didn't tell me what basis I'm going to share this 10,000, so I will just recognize this transaction over 2 years at 5,000 naira per annum, because this employee is going to work for 2 years and I've promised him I will give them shares. The value of the shares is 10,000. So at the end of the year 1, I recognize staff cost 5,000, and the corresponding equity reserve 5,000. At the end of the second year, I recognize another 5,000 in staff cost, the corresponding credit equity. That's it. So it would be wrong of you to say, Shebi is until after 2 years that I'm supposed to, that this 10,000 will vest. And then it should be measured and recognized at the end of year two. No, that's wrong. That will be against accrual basis. So the idea of accrual basis is that as you are enjoying the service, recognize the expense. Recognize it immediately. Okay, so that's what we're trying to explain here. Now, emphatically, in the exam, there would usually be some situations that we would face because this share-based payment arrangement is not usually arranged with just one employee. It will be arranged with many employees. Like it could be with 15 employees, and we will tell all of them that, okay, we will give you shares. So if you are with us for 4 years. So the only challenge here is that most of them might have left before the expiration of that 4 years. And they might not leave. So they might leave, they might not. So how do you deal with that kind of situation? Considering that you have to recognize and measure this transaction as they are offering that service to you. So it's not like you are waiting till the vesting date before you recognize it. You are recognizing it as they are offering the service at the end of each year. So the example I gave you of this 10,000 was very straightforward because I just assumed that, okay, let's share it equally for each year. But what the standard recommends is that at the end of the first year, okay, the entity will recognize an amount for the goods or services received during the vesting period based on the best estimates of the number of equity instruments expected to vest at the end of the vesting period. Okay, so that means that you would have to estimate. You would have to estimate that, okay, I would estimate that nobody will leave. Okay, so if you're estimating that nobody will leave, then fine. Then you just take a proportion like I did the other time, that I share that 10,000 into 5. I just assume that nobody would leave, that all of them will still be present. Okay, so it was easy for me. And another person might estimate that out of these 15 employees, 2 people might have left. You know that if 2 people left, the value of the share option will reduce. It will not be the same amount because that means it's not all of them that will now get it now. So since the total value has reduced, that means whatever you are apportioning to each year too, or that particular year where you are making that estimates, it will be based on the people that would actually get those shares. I mean, so the way you do it at the end of each year is you have to make an estimate that, okay, how many people would actually get these shares. You have to, because you wouldn't know how many people will leave out of your employees or how many people would remain. There's no way you can know. So it's estimates. So the good thing is that this is an exam. The examiner will now give you that estimate. You will just work with that estimate. You will see when we solve questions in class. So that's in the first year. So in subsequent years, you would be revising your estimates depending on new information. So each year you'll be making estimates depending on the information you have. And what estimate are you making? How many people would remain at the vesting date? We just want to validate the total value of that shares, okay, so that we can apportion each share properly, okay? So all of this ultimately is just complying with accrual basis, because you cannot do what non-accountants are doing, saying that we promise on people's shares, which we call share option, and we promise them that, okay, if they work for 5 years, then why are you not recognizing a portion for each year when they will get it in 5 years? No, accounting is not like that. It's accrual basis. As soon as the guy started working, even though you have not given the shares, but you have already started receiving the goods or services. And IFRS 2 says that as soon as you start receiving the goods or services, recognize it. So here now, what portion are you recognizing? Is you are now going to recognize, okay, how much exactly are we giving? How many shares are we giving? So that is when the issue of, okay, making estimate is now coming to play. Just to know, okay, what portion am I going to give to each year? What portion am I going to give to each year? So that's what we'll be doing at the end of each year until the vesting date. So which is when you can now see the reality. You can now see the reality, because on the vesting date, you will see the people that would actually get those shares. Then you can then update all your figures at the vesting date. Don't worry, you will see it when we solve questions, which we are going to now. Okay, just to be sure that you had the most important part of all I've been saying. So let's look at this quiz. It says that when a service is satisfied over time, in the first year, the equity instrument granted and the goods or services received will be measured at, what's the answer here?
Sorry, can you scroll down? Can't see the options.
Okay, can you see it now?
I
Fair
think
value
it's
of the
good,
goods or services, fair
but let's
value
scroll
of the
down. Can't
instrument,
really. It's
best
only A
estimate.
and B.
No, there's C, best estimate of the equity instrument expected to vest at the end of the first year.
The answer is
Also
C.
C.
Okay, good. So is the best estimate of the estimates expected to vest. Okay. So that is the whole of the explanation for equity settled. So we'll just solve some questions, then hopefully you will get it very fast, then we can close the class. So don't forget, the entire thing is just about companies paying with their shares. So ICANN will not ask you transactions with suppliers, but if they choose to ask, fine, lucky for you. So you just simply debit whatever service you have received or goods and credit equity reserve. That's always straightforward because suppliers would have rendered the service immediately. But what we find is that they mostly ask you transactions with employees and there will be vesting period. So so what they are just testing there is just to be sure that you understand that you will not wait till when we actually issue those shares or when those shares vest before you recognize. You start recognizing it as soon as you start receiving the goods or services. And that's the recognition criteria for share-based payment transaction when the goods or services is received. So for an employee rendering service for you for over 4 years, that means you recognize the transaction over 4 years. And the basis of recognition each year will be based on the best estimate of the employees that will vest. okay, or that will remain. So that's the entire idea. So let's look at this question and see if you can understand it. I'm sure you will. So 4.6, it says that on 1st January 2001, an entity grants 100 share options to each of its 400 employees. Each grant is conditional upon the employee working for the entity until 31st December 2003. The fair value of each share option is 20 naira. Second paragraph. During 2001, 20 employees leave, and the entity estimates that 20% of the employees will leave during the 3-year period. Second one, during 2002, a further 25 employees leave, and the entity now estimates that 25% of the employees will leave during the 3-year period. And during 2003, a further 10 employees leave required. Calculate the remuneration expense that will be recognized in respect of the share-based payment transaction for each of the 3 years ended 31st December 2003. Okay, so that's the question. So like I've explained before now, so this is the grant date, 1st January 2001. An entity grants 100 share options to 400 employees. Okay. And the condition is that they must work till 31st December 2003. That's 3 years, 1, 2, 3. And the fair value of the share option is 20 naira. So you need to take special care of this fair value of the share option, because what the entity issued there is share option, not shares. And for transactions with employees, you measure it at the fair value of the share option. So you see, the fair value of the share option, the relevant one you need, please pay attention and listen to this. The relevant one you need is the fair value of the share option at the grant date, because the examiner could intentionally give you share option, fair value of the share option for each year. Don't use those ones, though. Is the fair value given at the grant date that we are going to use. That's one that is relevant for us. So that being said, you see, the basis of everything is just so that you would ensure you recognize this transaction truly over 3 years, not only at the end of 2003. You recognize from the end of 2001, you recognize a portion. At the end of 2002, you recognize a portion. At the end of 2003, you recognize a portion, right? So assuming they didn't give me this, if I close my eyes to all of this, you see, the way I will have recognized it is this. Just look at this. The way I will have recognized it each year is this. So in year 1, what I will have done is that, okay, I gave 100 options to 400 employees. That would be like 40,000, right? So 40,000 value of shares. And the fair value is 20 naira. So that means the total value is actually what? 800. That's the total value. So since I'm giving all of them a value of 800, and I'll give them at the end of the 3rd year. So, and this standard says that as they are offering the service, you recognize it in my book. So what am I how much of this 800 should I recognize in year 1? Straightforward, just divide it by 3. Whatever you get, that's how much I'll recognize in year 1. The same amount is what I'll recognize in year 2. the same amount is what I'll recognize in year 3. Then it will have been that simple. However, the examiner didn't actually give me a guide. So I will have done it the way I've worked it out like this. If they didn't give me a guide, they didn't say anything, they just gave me this. So doing it like this is assuming that, okay, all these 400 employees, they are, like, I'm sure that at the end, at the vesting date, they will be there. I'm sure in year 1, year 2, year 3, I'm sure that they will be there. That's the assumption of doing it this way. However, the examiner thought otherwise and said that, okay, at the end of 2001, in fact, during 2001, 20 people actually left. Out of these 420 people left in 2001. So on that basis now, they now estimated that 20% of the employees will leave during the 3 years. During the 3 years. So, which simply mean that they are estimating that, you see, this option I'm giving to 400 employees, at the end, because they said during the 3 years, please note that. So what that means is that at the end of the 3rd year, only 80%, of the employees, that's 320, would actually get this arrangement. Only 80%. So whatever I want to share now, whatever I want to apportion now, because I know it's good for me, since I know 20.
Sorry to cut you off. These 20 employees, we don't consider it yet until the 3rd year when we know the actual employees that leave or what. I'm just trying to say.
Yes, yes, yes. That's correct. I won't consider it yet. I mean, it depends, really, but I'm not considering it for now because I'm more focused on my total exposure, as that based on this information I have now, how much am I supposed to give to people now? Because since they said 20 people have left, and on that case, I'm estimating that only 20% will leave during the 3 years. So in 2001, look at this place. In 2001, what I'm then doing is that, okay, these 100 options, right? I know that only 80% of these 400 I'm going to give to now. I'm going to give to multiply by 20. That is my liability now. If they have said all of them will remain, it will have been 100%. But for the fact that I'm estimating, for the fact that 20 people actually leave, so then I know that not all of them would be there at vesting date. So first, I need to establish that, okay, how many people or how much am I giving to people now? So I'm giving 100 options only to 80% of 400, then multiplied by the fair value of the share option. So by the time you multiply this will give you an idea of the value of those share option. So since I'm recognizing a portion in 2001, so I will just take 1/3 of whatever that is. So if you punch that on your calculator, it gives you this. So the first leg, go to equity, cumulative expense, go to equity. The second leg will go to staff costs under my expense. Will go to staff cost under my expense. So the entire idea, if you really want to enjoy this thing, if you really want to enjoy it, so the entire idea is that I'm giving some people share option. What you just need to get, your focus should be, okay, based on whatever information the examiner has given you, How many options am I giving them now based on what is happening now? So based on what is happening now, I'm giving my exposure is just 100 option on only 320 because I've estimated that 20% will have left. So only 320 is what is still an estimate though. So, and each of them is worth 20 naira. This is the value of what I'm giving. So I will then share it. For this first year, to just be multiplied by 1/3. That's that. So you see that you won't have to bother yourself about the number of people that have left because it is the number of people that have left that actually give us the idea of the total value of the share option. So your mindset, your focus should be on, okay, on each share, what is the total value of the share option? Okay, what is the total value of the share option now? Okay, now. And that means total value of the share option that I want to give people at vesting date. Okay, so in year one, I will now take a portion of that, which in this case is 1/3. In year two, the examiner went ahead to give us additional. He said during 2002, a further 25 employees leave. And the entity now estimates that 25% of each employee will leave during the 3 years. During the 3 years again. So they saw that during year two again, additional 25 left. So on the basis of that, we now say that at the end of year three, a total of 25% of our employees will have left. A total of 25%. So again, I will just do 100 multiplied by 400 times 75%. Times 75%. So in year two now, I will just do times 2/3. Okay, this is year two. So that cumulative, if you punch this on your calculator, it gives you 400,000. That's what will go to equity reserve. It's usually cumulative. But what will go to your expense is incremental. Which is this 400 minus 213,333. That's what will go to my P&L. Okay. Then in 2003, they said a further 10 employees leave. A further 10 employees leave. So 2003 now, this is the vesting date. Then I can then know, okay, how many people have actually left? How many people have left? So from here now, I know I have 100 options. And initially, I had 400 employees. How many left in year one? That's a question to you. How many left in year one?
20.
Okay, 20 left in year one. How many left in year two?
25.
25. How many left in year three?
10.
10. Okay, so I then multiply by that fair value of the share option at the grant date, 20 naira. So when you do that, you punch your calculator with that, you will get 690,000. That's what will go to my cumulative, which is equity reserve. Then 690 minus 400 is what will go to my P&L as staff costs. Okay, so really, if you understand this one, it's not more than this. It's not more than this. So a lot of students usually get some few things confusing here, which should not be, because if you understand the initial fact that we want to give some people share options, right? and they need to work for us for 3 years. So ultimately, we are giving them these shares at 2003. But because of accrual basis, we are saying that, okay, don't wait until 2003 before you recognize this thing in your books. Recognize it over the 3 years. As you are receiving the service, recognize it. Okay. So ordinarily, if they didn't give us all of these stories, I would just, in each year, I would just divide it by 3 equally. 100 times 400 times the fair value of the share option at the grant date. Whatever I get, which is the fair value of what I want to give out, I divide it by 3. But I mean, we need to face reality that it's not all of these 400 employees that will actually be there to enjoy this thing, which is good for me. Good and not good. Well, from the value proposition standpoint, not good. But from the fact that what I'm going to be giving out is now less, is good. So year one now, I saw that 20 people left. So on that basis now, I need to know, okay, if 20 people left in year one now, so what is my total, what's now the total that I'm going to give out at the end of year three? So it would be wrong for you to consider year one alone. It would be wrong because you are restricting it to year one, but you need to, because what you are sharing over 3 years is what you will ultimately give at the end of year three. So that's why you need to consider, okay, how many people will actually remain at the end of year three? There is no way you can know that other than by estimates. That's why we usually would work with the estimates, okay, until the vesting date. So this guy has helped us. He has told us, okay, 20% of our employees will leave over the 3 years. Fantastic. Then I can then take 80% people that will remain times the option times 20. That gives me the value of the option that I'm giving at the end of year three divided by 3. That's year one. Year two, they told me that additional 25 left. I can't work with just that. I need to know how many would have left at the end of year three, right? Because that is what I'm ultimately want to share now. So based on new information, is now 25% that will live over the 3 years now. And it's over the 3 years period. So this is speaking to the entire period, not year two and three, speaking to the entire period. So out of these 400 now, that means only 75% will remain times 100 times 20. That gives me my total value of the shares I want to give out to people. Multiply by 2 over 3, that gives me to cumulative, is the incremental that goes to P&L. Then in year three, now I will have known people that have left. So no sweat. So 400, 20 left in year one, 25 left in year two, 10 left in year three. Multiply by 20, 690. The cumulative, the incremental goes to P&L, which is 690 minus 400. So that's the focus. Let's look at another question. Question 2. So in this instance now, they said on 1st
I
January
have a
2000.
question.
Okay, please go ahead and ask.
If at the vesting, this is a very hypothetical question, scenario anyway.
Oh,
If at the
okay.
vesting, which is the end of 2023 or 20x3,
Okay.
okay, there is no employee at all. So what
Okay.
happens? All these entries we have passed, we'll start reversing all of them. The
So,
expense, the equity
So,
instruments that have been
mm,
created. They didn't fulfill the condition. So we'll start reversing all of them.
okay, let's practicalize it now. So that means it will just be 400 minus 400. Abi?
Yes, yes,
That's 0. So that means the cumulative will be 0. Abi?
yes,
Right?
yes,
So what will be the incremental?
yes.
This will be 400.
minus 400.
Thank you,
Maybe,
minus 400. That will be an income to us.
yes, it credits to the POL.
Yeah, that's what will happen. So fantastic question. Oh. A very good question you have asked. So that's what you just do. So
So would that sit on that
uh,
other income as a reversal of I don't know, like what would you call it?
Sorry, I didn't get you.
So would that sit under other income or you aggregate it under admin expense?
It
So
appears it's
Don't
going to
aggregate,
reverse there will just be a reversal.
don't aggregate it, or you put it as other income. And
Oh, okay.
you put it as other income. You are not going to reverse everything, no. I mean, it's just step by step because you are making different estimates each year. So those figures you have recognized it, you have recognized it. So at the end of year 3, everybody has left, right? So that means you are not paying anybody zero. So whatever was in your reserve, because as at the end of year 2, the cumulative amount, the value of as at that date was 400. So since nobody is there now, that this one is now zero. So that means your reserve has reduced from 400 to zero. So just transfer whatever the difference to your P&L as an income. So you didn't utilize it.
I think that make yeah that appears to be yeah, that appears okay.
It's a very good question you asked. Okay, so on 1st January 2003, an entity grants 250 share options to each of its 200 employees. The only condition attached to the grant is that the employees should continue to work until December 20x6. 5 employees leave during the year. The market price of each option was 12 naira at 1st January 2003 and 15 naira at 31st December 2003. Show how this transaction will be reflected in the financial statements for the year ended 31st December 2003. Okay, so how do we deal with this? Similar to what we have done, but this one is a bit straightforward. They want us to focus on just 31st December 2003 alone. So at the grant dates, 250 shares, 200 employees, and the employee must work till December for 4 years, 3, 4, 5, 6, 4 years. So they now told us that 5 employees left during the first year. And that was all. So how do we deal with this now? At the end of year 1 now. Because I know that my focus is I need to know what is my value of those share option, which is 250 multiplied by 200, Abi,
times
multiplied
12.
by 12, right? Which is the fair value of the option at the grant date. Don't go and use 15 naira. Is always the fair value at the date of the agreement times 12, right? So what will this one give you now? What would this one give you?
If we
Sorry, I had to mute.
600.
Sorry? 600. 600,000. Okay, so I can simply divide this by 4, and that will have given me 150. That's if I'm assuming that nobody is leaving. But this guy told me that 5 left in year 1. 5 have left in year 1. So it's not the whole of these 200 employees that will get it. So my total value of share option is not 600 anymore. So I need to know how many people would be there at the end of year 4, at the end of 2006, so that I can know first what's the value of my share option. So on the basis of this, I can estimate. So this question is now giving you opportunity to make estimates yourself. So don't forget, that's a core principle of equity settled. It's measured each year at the best estimates of the number of employees that will remain. So for me, I would just, if I was exposed to something like this in the exam, and I know that 5 left in year 1, I'll just estimate that, okay, 20 will have left over year 4, over 4 years. I'm just assuming that, okay, 5 will leave each year. It's just an assumption. Another person might say that, okay, it's just those 5 that will leave over those 4 years. Just that you need to state your assumption in the exam. So for me, if I assume that, okay, 5 will leave each year, so that means as at today, okay, as at what is happening today, based on the estimate I'm making, 20 will leave before the vesting date. So the value of what I want to share over 4 years will now be whatever we get here. Can you give me this figure? 250 times 180 times 12. Anybody?
540,000.
540,000. Okay, so this is the value of what I want to share over 4 years now. After making estimate of people that will remain at the end of year 4. So I just divide this by 4 in year 1. Whatever you get is what you'd recognize in reserve and your equity and your staff costs. And that was the solution I have here. So ultimately, I assume that 5 will leave each year. Then 135 was what I recognized at the end of 2003, which is 45,000, which is the 250 times 180 gives you 45, multiplied by the fair value of the share option at the grant date, and then multiply by 1/4. And that's that. Now, another question.
Sorry, maybe I didn't get you. That estimate, how did you get the 20 again? Why is it
Okay.
not 5 that we're deducting at 2003?
Okay, so since the examiner did not give me the estimates, they only told me that, okay, 5 left in year 1. And I understand that it's not year 1 I'm working with. Even though I want to recognize a portion of this fair value in year 1. The basis of my calculation is not year 1. The basis of my calculation is how many people will remain at the vesting dates. So I said you can assume that, okay, at the vesting dates, it's just these 5 that have left in year 1 that would only leave. No other person will leave till the end of year 4. But I said that I would assume that since 5 is leaving in year 1, then 5 people will leave every other year. Year 1, 5 will leave. Year 2, another 5 will leave. Year 3, another 5 will leave. Year 4, another 5 will leave. So 20. So I'm estimating that out of these 200, only 180 will remain at the end of year 4. So that I can get the value of my share option first. Then it is now that one I will now share over the 4 years. So I then divide that by 4. That was what I did. So if you are using just 5, that means you are estimating that no other employee will leave. It's just only these 5 that will leave. So no other person will leave over the 4 years. It's just these 5 that have left in year 1. So if you state your estimate clearly like that, that means your own calculation will be 250 times 195 times 12. Then you multiply by 1/4 in year 1. It's okay. But you need to understand that the basis of that 5 is not for the fact that because somebody 5 left in year 1. No, that's not the idea. The idea is that I need to know, based on the information I have today, how many people will remain at the end of year 4. Okay, that has to be the focus. That's the focus you need to have. So that at the end of each year, you will know, okay, how much is the fair value of this option first. Fair value of this option on the assumption of that, based on, okay, how many people will remain at the end of year 4. So you are knowing, okay, this is my exposure as at today. This is my exposure as at today. Then it is that one you are sharing over the period like that. So that's it for that. So that's why I use 20. If you are using 5, don't say it's because 5 people left in year 1. No, you are using 5 because that is the people that will have left over the 4 years. If you understand that, good for you. Now, let's solve another question. So this one says that J and B granted 200 options on its 1 naira ordinary shares to each of its 800 employees on 1st January 2001. Each grant is conditional upon the employee being employed by J and B until 31st December 2003. J and B estimated at 1st January 2001 that the fair value of each option was 4 naira before adjustment for the possibility of forfeiture. Approximately 50 employees will leave during 2001, 40 during 2002, and 30 during 2003, thereby forfeiting their right to receive the options. The departures were expected to be evenly spread within each year. The exercise price of the options was 1.50 kobo, and the market value of the J and B share on 1st January 2001 was 3 naira. In the event, only 40 employees left during 2001, and the estimate of total departures was revised down to 95 at 31st December 2001, 20 during 2002, and the estimate of total departures was revised to 70 at 31st December 2002, and none during 2003, spread evenly during the year. Required. The directors of J&B have asked you to illustrate how the scheme is accounted for under IFRS 2 share-based payments. Show the double entries for the charge to P&L for employee services over the 3 years, and for the share issue, assuming all employees are entitled to benefit from the scheme, exercise their rights, and the shares were issued on 31st December 2003. Okay. So for this one, so we granted 200 options on my shares that has a nominal value of 1 naira. I granted it to 800 employees. The grant date is 1st January 2001. So each grant is conditional upon the employees being employed by J&B on 31st December 2003. So it's conditional on the guy being there, working for me for 3 years, 1, 2, 3, yeah. So that's the condition. Again, if they were silent, they didn't give me all of these stories, I would have just simply said that, okay, I'm giving 200 option to 800 employees. I will just look for my fair value of those options at the grant date, which is 4 naira. If I multiply that by 4 naira, then I will be looking at around 8 times 8, that's 16, 0, 0, 0, 4 zeros. So that's 160,000. So this will be the value of those that's the value
Okay,
of
why
the
did you use 4
option.
naira again? Maybe I'm not
This
following.
one, yeah,
Mm.
value of, sorry, you said what? Where did I get it? Or why did I
Why
use
did
it?
you use, why did you, yeah.
Yeah, that's how you measure it in naira now. You need to convert this 200 option, 800 employees, multiply by 4 naira, which is the fair value of the share option at the grant date. So that gives me 160,000 naira. So this is the value of that share option. So this 160,000, don't wait
Okay, I'm
on.
just seeing.
Okay. Somebody said it's 640. Yeah, it's 8 times 8. Yeah, 640. Thank you, Mohammed. 640. So this 640 is the value of those share option. So what we are saying is that don't wait until 2003 before you record it. Why don't you spread it over 3 years? So each year you are recording a portion, right? But it won't be that rosy because not all these 800 employees would be there every year. So at the end of each year, you need to be sure how many would actually vest, just so that I will be able to know what's my total exposure, just so that I can determine the fair value of that option. So I'll be able to know what I want to share over the 3 years or over the remaining period, as the case may be. And that's why they went ahead to give us some estimates at the beginning of the year. So ordinarily, if you had listened to me very well, you will know that you will do with this they have given you, you will not use it for anything except for this fair value of share option, because that is relevant. You measure equity settled with employees at the fair value of the share option at the grant date. So this formula is what we use to measure it. But the estimate you make is made at the end of each year. You make estimates, you measure the fair value based on the best estimate of the number of equity instruments that would vest at the end of each year, not at the beginning of the year. So this guy was making estimate at the beginning of the year. So this one is just not useful to us for the fact that they made the estimate at the end of the year. So I'll just be watching out for them. So they went ahead and gave me the exercise price. So this guy ultimately, at the end of 2003, they will pay for the shares. They will pay 1.50 kobo. They gave me the market value of my shares at the beginning of the year of 3 naira. Some students will go and use this one to value share option. They will ignore this, the value of the option. Why would you go and use shares? What they have issued is option, not shares. Okay, so it's the fair value of the option that is relevant, not the fair value of the shares, even though this one too is at the ground date. But this is not what this one is relevant. So now in the event only 40 employees left in 2001. So they now estimated that total departures was revised down to 95. Okay, so is this one that is relevant? Is this estimate that we'll use in 2001? I cannot use this estimate of 50 employees leave. It's not relevant for me because the estimate was made in 2001. So I can't work with that for several reasons. But with this information now, if I want to show you in year one, what I will recognize first, I will need to get, okay, what's the value of my exposure now? What's the value of this option now? Considering that I've estimated that this 40 wasn't estimate because 40 actually left. So on the basis of this 40 that left, I need to then start thinking about how many employees will remain at the end of 2003. The examiner already gave me the estimate. So because they said the estimate of total departure was revised to 95 at the end of the year. So they are saying that, okay, out of my 200 options, I'm going to give it to only, if I take away 95 from 800, that will remain like 705. So those are the only people that I'm estimating will be there. And the value of this is 4 naira. The value of this is 4 naira. So can you press your calculator to tell me how much? How much is that? Punch your calculator. You cannot put your calculator, punch your phone. Every phone has a calculator.
564,000.
4,000.
Okay, 564,000. Okay, so that's the first thing I need to know. So I know that, okay, my total exposure now is 564,000. Okay, that's what I need to give to these guys at the vesting date. So how much of these 564,000 am I going to recognize in year one? I know that the vesting period is over 3 years. I just divide it by 3 years. Okay, so punch your calculator, what's that?
188,000.
Okay, 188,000. So one leg will go to where? Staff cost, P&L, abi? The other leg will go to where? Equity what? Equity reserve. Debit staff costs, credit equity reserve. Okay, that's for the first year. Now, for the second year, for the year two now, what did they say? They said 20 left during year two now. Okay, so additional 20 left. Now, that is not what concerns me now. Because additional 20 have left, I need to start thinking that, how many will now remain at the end of year three so that I can know how much is my total exposure is. I can know how much is the total value of this thing is. Because that is what I want to share over the remaining period. But the examiner was very generous. He told me, he said, and the estimate of the total departure, thank you. He has made my life easy. He has given me total people that will live over the 3 years. They said it was revised to 70 at the end of year two. Thank God. So 200 out of 800 is a new estimate. Though. Some people will go and say, Shebi, we said 95 people have left. No, it was an estimate. Though. So estimate of total departure before was 95. But now we have now revised it to 70 total departure. So out of 800, I'm estimating that at the end of year three, 70 will have left. It's estimate too. I'm not a magician. No, there is no way I can know the actual people that will live at the end of year three. Unfortunately, I need to know. That is what is important for me. What is my total exposure? Because that is what I would now then apportion over this year. Okay, because it's the end of the year I'm paying these guys. That's when I want to issue this share. So that is where my focus is. So how much now? I've estimated that 70 will have left. And I'm still going to use the fair value of the share option at the grant date. So please, let's punch our calculator. How much would that give me?
584,000.
584,000. Okay, so in year two now, we just use cumulative year one and year two. So multiply by 2 divided by 3. What would that give me?
389, 389,000, 333.333, whatever.
Are you talking to them?
Okay. So this one is the cumulative now. So this is the cumulative that will be in my reserve, but is the incremental. This one will be in my reserve. So, but what goes to P&L is the increase in my reserve. So what goes to my staff costs is this 389,333 minus 188,000. What would that give me? What would that give us?
201,333.
201,333. Okay, good. So now in year three, I know people that have left now. Everybody that has left over the period, I can know, okay, this is how much I'm actually going to give. This is the value of the share option that I want to give to my people. So now, at the end of year three, now they said none left during year three. No problem. So nobody left in year three. So I'm giving 200 options now. Out of my 800, I knew that 40 left in year one. Okay, 40 left in year one. I know that 20 left in year two. I know that 20 left in year two. So out of 800, 60 have left. multiplied by the fair value of the option at the grant date is still at 4 naira. So how much would that give you?
592,000.
592,000. So this is what goes to this is what will be in my reserve. Okay. So in my staff costs, how much goes to my staff cost? 592,000 minus what? 389,333. The
202,667.
202.
667.
667. So now I've solved this A part. So in year one now, I debited staff cost with 188. I credited equity reserve with 188. In year two, I debit my staff cost with 201. I credit equity reserve with 201. Because when you credit equity reserve with 201, it increases to this. In year three, debit staff cost with 202, credit equity reserve with 202. When you do that, it increases to this 592. So I hope you are getting the idea that at the end of each year, I need to know what is my exposure based on the estimates. The examiner will always give you the estimates. So don't go and say, don't ever fall among the students that will never understand this thing, because they will keep saying, maybe it is 40 that left in year one. Hey, why didn't I deduct 40? I like, no, that is not what we are looking at here. At the end of the standard is clear. Okay. The focus is we want to give people shares at certain future dates. Okay, but we are saying don't wait until that date before you recognize it. Recognize it over the period. So for the fact that humans move where we don't have control, so they can live, so at the end of each year now, situation might have changed. Okay, like in this case now, 40 people left. So on that basis now, I need to now know, okay, how much what's my exposure now? How much should I reserve? What's my exposure? So my exposure, you don't consider only year one alone now. You consider all the period, because your focus or your target is that future year. So the examiner always makes it easy for you. It will give you the estimate of total departure. Okay, is either they give you an absolute amount or they give you in percentage, like the previous question that we did. So this one gave me estimate of total departure in absolute amount, 95. So over the 4 years, it has estimated for me that 95 will leave. Then multiplied by my values, I know that, okay, my total exposure is 564. I cannot recognize the entire 564 in year one. I divide it by 3. In year two again, they told me my total exposure or my total departure is 70. Total departures, now I know how many people will remain at the vesting date, multiplied by my variables. I know that my total exposure now is 584. I cannot recognize this entire 584 in year two. I cumulate a portion, multiply by 2 over 3, 389. I know in the incremental is what goes to P&L. In year three now, now I know how many people so this is my actual exposure. Actual. This is what I'm actually going to give to people. 592. And that's what in my result. So, and that's what this B part is actually talking about. So that show the double entry for the share issue. That okay. So how do I then issue shares to people that remain? In this case now, how many people are remaining? 740 people are remaining, Abi, and I'm giving them 590. So the first thing is this: they are going to pay 1 naira 50 kobo for those shares. So 1 naira 50 kobo multiplied by how many share options now? 200 share options. How many employees? 740 employees. No, 740. So So 740 times 200 multiplied by 105 or multiplied by 1.5. What would that give you?
222,000.
So you use the exercise price as at the grant date.
Yes. That's how much the employees will pay. It's not free, they will pay.
And
Just
that's what I'm saying. For the payment, you use exercise price at the grant date.
yes, correct. The exercise price. So they are paying 1.5 naira. So that's that. Then this equity reserve now, I need to then transfer it to my share capital. It's a credit entry. I debit it. So I cancel it out entirely. That's 592. So that equity reserve is gone. So I need to transfer to share capital. However, I can't transfer this entire 592 to share capital because what goes to share capital must be at nominal value. And my nominal value is 1 naira. So 1 naira multiplied by 200 employees multiplied by 200 options times 740 options. So how much is that?
148.
148,000. Then the balancing figure, don't even stress yourself. The balancing figure goes to share premium. Balancing figure. Just for you to balance. Amy, if you had 222 plus 592, what would that give you? 222 plus 592, what would that give you?
814.
814. So remove 148.
6666.
666. That's it. That's how you issue it out. You issue those things out to your employees. So that's it for equity settled. That's the basics for that. If you understand it, congratulations. It's never more than this, really. It's never more than this. So, again, don't fall in the trap of students that they will continue to get it wrong because they will never allow their mind to be flexible to the point of thinking that what we are talking about here is what is my total exposure each year first. That's the first thing you need to consider. So for that reason, you will not say that maybe it's 40 that left. So why won't I remove 40? No, it's not about who left in a particular year. It's about how many will remain at the vesting date. That's what you are concerned about. So at the end of each year, I need to know, okay, how much am I giving to people? So how much am I giving? So it is how much you are giving that you will now share to each year. So this 40 that actually left in each year, or 20 that left in second, it just would point you to making an estimate of, okay, then
So
this is what number that should remain. Okay, yeah, precious.
I'm just looking at this value that we're increasing our bank with. Can you explain that a bit?
Oh, exercise price. So it's not for free, they pay. So the employees that are
So,
enjoying the
yeah.
options, they will pay
Mm,
1.5 each for each
okay.
one.
And then what they get is the 592.
Exactly. Precious. You're intelligent. Thank you. Okay. Mm, So stop here for today. So next week, I thought I would be able to do modification, cancellation, and reassurance. It's still part of equity settled, but I would appreciate if you can go and understand these ones very well. then it will make modification to be easier for you, because modification, cancellation, and reassurance builds on, it assumes you understand those ones very well. So I could as well continue because I want to believe all of you understand it. So what I will just do is there's some questions, there are practice questions at the end of these notes when you look at it. So you look at these practice questions here. So just practice some of these things. Most of them are equity settled anyway. So just try them. So next week, the class will be faster because there will be nothing new anymore. We will just be building on the foundation we have laid tonight. So within 1 hour or a little after 1 hour, I would expect that we will finish share-based payments. Then we would move on to IAS 19, employee benefits, next week. So I urge you to revise and let's call it a day tonight. So thank you guys. I will see you same time next week. Bye for now.